we have a fleet of, I believe, 15 dry bulk vessels today. 8 of those vessels are on long-term charter to Golden Ocean, have been so for 8 years or so. And then we have 7 other vessels. The vessels from Golden Ocean, to take them first, we have a charter deal there with Golden Ocean where we have a base charter rate and then a profit split on top. So this quarter there was a $2.2 million of additional cash flow from that profit split arrangement on those vessels. But in addition to that, we also have 7 smaller dry bulk vessels. These were vessels that used to be on long-term charters. So when we acquired them back in the days, they all had a combination of, the Supramax bulkers. They had between 5 and 8 year charters to Glovis at the time, and then we have 2 Kamsarmax bulkers. These are GLS, a little bigger. They were on a 10-year charter to a Chinese dry bulk, commodity company. So what has happened with these vessels is that the original charters have come off. We have depreciated the vessels over that charter period. And part of our, I would say, operating model and some part of the value of our platform is that when we have a vessel that comes off charter, we are not desperate to dispose of a vessel. So it's all about timing things right. You don't want to sell or charter it out again long term at the low end of the market. Then it's better to trade it through a downturn and then see what you can do as the market does come up. And that's what we're seeing on these vessels. They are getting a little older now. So the Supramax bulkers, just to be specific on those, they are now between 14 and 11 years old already. So I would say they are vessels that are probably more at the tail end in our portfolio, and it's not so easy to find long-term employment for this vessel category in the first place.
Could you go a bit into the current utilization rates and the rate environment for these short-term vessels?
Yeah, I mean, these are workhorses in the market, commodity vessels. Utilization is very high, close to, on these vessels between 95-96% utilization. We are trading them. 2 of the vessels are commercially managed by Golden Ocean. Those are the Kamsarmax bulkers. And then the 5 Supramax bulkers are commercially operated by a third-party specialist who's focusing on the Supramax market mainly in the Atlantic. So these are performing, quite well, producing good cash flow. We don't have any debt on the 5 Supramax bulkers, so anything above the OPEX goes, you could say, straight to cash flow. Running these vessels is in the region of $6,000 per day, $5,000 to $6,000 per day, depending on where they are and maintenance, etc. That is being done on the vessels. So now when they're making sort of $14,000, $15,000 per day, it's not a bad business in itself.
So there's been quite some hype related to dry bulk so far this year, and people are saying that this is the next oil tanker story and so on. And if we look at your the Q1 EBITDA contribution from dry bulk, it was about 10% of the total, if I'm not mistaken. And could you take us through some different rate scenarios up ahead and talk a bit about how high the EBITDA contribution could get from the dry bulk side?
Yeah, well, we don't guide specifically on individual segments. These vessels are really trading in the market. So you could say anybody can follow the market, and you could expect these vessels to earn somewhere ballpark where the market is. I mean, none of these vessels, I mean, they are older. They don't have any special features where they have sort of any particular advantage over other similar type of vessels. So good trading horses. From our side, our main focus is really on the long-term assets where we have long-term employment to industrial owners, and these are, I would say, vessels that we trade what can we say? We make the most out of the vessels, and you know, it's always a decision. You know, should we continue trade it and enjoy the benefit of the cash flow, or should we sell the assets and reinvest in newer vessels? So I would say this is part of our ongoing fleet management. We always have, when we have a 20-year history, we don't have any of our original vessels left in the fleet. Everything has been sold and capital has been reinvested, and that's an ongoing process when you run a portfolio of 70 some assets like we do.
To which extent should we focus on dry bulk as a value driver for SFL in the coming years?
I don't think really dry bulk is the key for a company like SFL. Where we have a real edge is more industrial logistics type of assets, and the dry bulk, and particularly the smaller dry bulk segment, is more of a commodity type market. So there are many players. Most are just market takers. There are some opportunities, and there have been opportunities on the larger vessels to more industrial companies, but we have like ore carriers, etc. But haven't so far, bought any of those.
Let's move a bit over to China and the coal imports. We recently spoke with Nalios Maritime Partners, and they suggested that there is a structural shift going on in Chinese domestic coal production and imports, and that this is going a bit under the radar. Could you go a bit into this, what this is all about, and what do you think about the effect we could see on the dry bulk rates?
Well, we're not really dry bulk specialists. As I said, our vessels are really traded in the market, and we are effectively price takers in the market. So we don't have any sort of particular view on a sub-segment, sort of the underlying market or the market driver. The coal market is typically, very focused on the Panamax market, and also on the coal on the Capesize from Panamax and up. That's where where you see more focus on that segment. So Golden Ocean would probably be more into the details on that, and they also have more, call it spot exposure to that subsegment.
Great. Let's move over to the energy side, and when we look at the revenue contribution from energy and the Hercules rig, it seems it rose nearly 50% in the first quarter. Could you just quickly recap what's been happening and what we're looking at in the coming quarters?
Yeah, so you're absolutely correct. That rig, from a book revenue perspective, it came up sharply. Part of the reason for that is down to US GAAP accounting rules, because in the fourth quarter, the rig had been drilling in Canada for Exxon. Then it was in transit, or mobilization, as it's called in the in the drilling language, and then it started drilling for Galp in early first quarter, which means and on the US GAAP we are not allowed, even if we are compensated through the mobilization fees we receive from the oil company, we're not allowed to recognize those in our accounts for the period when it's in transit. We have to pile everything on top of the drilling rate when it's actually drilling. So a part of the revenues from uplift from the first quarter was really spillover from the fourth quarter, but in combination with OPEX. So it's both things, but as it's making more money than the OPEX, there is a significant uplift there. Also, we had Linus working all the way through the quarter. In the fourth quarter, there was some off-hire on that rig relating to some equipment that had to be changed over. In the second quarter, however, there will be a significant portion, 2 out of 3 months, the Hercules will be in transit from Namibia up to Canada, where we, even though, again, we are compensated for that through mobilization fees, we will not be allowed to recognize it in the P&L in the second quarter. At the same time, Linus is now in a scheduled 5-year special survey, which started a week ago, and it's expected to last towards mid-late June. So I would say from the energy side, first quarter was a very good quarter from a book revenue perspective. Second quarter is going to be softer, but then we will have a significant pickup again in the third quarter. So the dilemma or the issue with having assets like that is not on a long-term fixed contract, is that you will see significant variation book news over and above where the market is, if you can call it that. But the market there is quite. We have seen the rate, the charter rate the rig has in Canada is very firm. And we are now marketing the rig for employment into 2025. So there isn't anything fixed, but the market seems robust. These are the ultra harsh equipment. This rig is winterized. It's worked up in the Barents Sea during winter. It can drill on ultra deep water. Made a significant oil discovery for Gulp in Namibia just recently in very rough weather conditions. Had a very high utilization. So rigs of this caliber, has a real value. There are a few of them, so it's an interesting market where I would say near term there is some, what we say, it's necessarily softness, but it's not like it's a super booming market in the near term, I would prefer to say. But longer term, given that an asset like Hercules would probably cost north of $1 billion to build. And to do that, the old rule of thumb was that a 500 million asset would require a $500,000 per day charter rate over a long time to make sense. So then you would talk more than $1 million per day, to make a new investment in an asset like that. And then, 500 plus, where we see the market right now, is a bargain.
You've been highlighting the rate leadership of the Hercules rig, and I saw that Seadrill reported day rates at 545,000 for Q1. I think that was a drill ship, but anyway, what are the chances that Hercules could achieve, could reclaim its leadership in terms of day rate?
Well, we will not make any predictions for what this rig will make. It's all, you could say, when you have a rig like that, so far it's been going on relatively shorter contracts. So was drilling one well in Canada, then it went to Namibia, drilled 2 wells, and then is going back to Canada again to drill 2 wells. So I think the key here is how do we ensure that the rig stays utilized, that there isn't idle time in between these contracts, or linked to the mobilization between the contracts. So far it's worked well, but of course, these are rigs that cost in the neighborhood of $180,000 to $200,000 per day to run. So needless to say, having that idle, means that there is negative cash flow. And then on the other hand, when it's earned sort of $400,000, $500,000, $100,000, maybe more, there is significant cash flow generation capabilities around the rig.
There are significant expectations in the offshore rig space that the day rates will pick up in the next years. And when we look at the quarterly representations from SFL, we always notice the the contributions from energy. What kind of EBITDA contributions could we be looking at if day rates were to reach 600,000 and 700,000?
Well, if you look at the EBITDA contribution in the first quarter, that was around $30 million from the 2 rigs combined. If we manage to keep the Hercules employed at around $500,000 per day, just the 1 rig will generate north of $100 million. The Linus is currently earning, when it's coming back to work after the SPS, the charter rate will be around $220,000 per day. for the next 6 months. That's on a market index rate, so it's also picking up gradually, which means that it's a little cheaper to run and operate because it's a jackup. But so on that one, we're talking 30, 32, 33, 34 million dollar EBITDA. So there is good capacity coming from these assets, but it also takes a little extra, what could we say, oversight and management, to run, because for now the Hercules is on relatively sort of shorter charters. It's more in the spot market for those kind of assets, if you can call it that. But the good thing here is that this market, I don't see any likelihood of new builds any near term. I mentioned Hercules found a Gulf estimated to maybe more than $10 billion of oil in Namibia. They need a lot more drilling there to develop it. They need probably multiple FPSOs, to develop that field. So finding oil is great. I mean, then the rig is doing its job for the customer, and when a happy customer sometimes becomes a repeat customer. So we hope that definitely there is more work for the rig. I mean, this rig can work anywhere in the world, also in benign waters, but it has these special capabilities, and it's upgraded to run in really ultra harsh environments, and that's why we hope that we will find good work for the rig there.
So you mentioned we are seeing the 500,000 these days in the offshore rig. Will you give any prediction on when we're gonna see 600,000 per day?
It's difficult to say. Odfjell just announced, those were unpriced options, or they announced priced options now in the $500,000 per day range for a similar type of rig in Norway. So I will not make any predictions. I'm sure market analysts on the drilling side, they have their views. Of course, there are two different markets here. I mean, one is for the drill ships, and the drill ship has some benefits, particularly in benign water, because they typically have dual operations. Also, a ship sits underwater and therefore has higher payload capacity, i.e., how much can you carry of pipe and mud and all the things you need to have on board to do the drilling, while the semis have a more stable platform. They work much better in really harsh environment, but you need more support from supply vessels, because there you have limits on how much weight you can put up, because it's elevated above water. There are more weight restrictions on what you can put on top of there. So this is all about in which area do you think there will be developments, like for Brazil, Gulf of Mexico, that's typically a drill ship market. Some of the places also in West Africa, more drill ship, call it angled, while in areas where there are really harsh weather, the semis are definitely, preferable. So I would say if you look at just the near term, when you listen to the rig companies as they've been presenting their first quarter results recently, I think there is optimism definitely, but I think they are guiding more that near term, it's all focus about keeping the rigs working without necessarily having a significant push on charter rates. But everybody basically expects this market to be sold out, relatively soon. And in a sold out market, rate can be, anything. It's you could potentially see unprecedented charter rates down the line. I mean, one of the rigs we did own one time that was on a bareboat to Seadrill, there was a semi that worked 6 years at $640,000 per day for Petrobras, as an example. This is a less capable rig than the Hercules. So there is no reason why you shouldn't potentially see similar rates, going forward. Certainly not with an oil price where it is now and perhaps increasing. Also, I would say with increasing, focus on the Middle East and the tension in the Middle East, I think many oil companies are now focusing on building the reserves also outside the region, simply to hedge their production in case there is an escalation of conflict.
Great. Let's have a look at containers, and we know that SFL has a long contract duration, but what about container shipping in general? Can we call off the feared oversupply at this point?
Well, if you look at the container ship segment, the container ship market is very similar to the airline market. It really looks more, it has many more similar characteristics as the airline market as it does with a tanker or bulker market. It's part of a logistics chain, and it's all about cost per produced unit. For a container ship, it's per transported container box. There has been, after that boom we saw during COVID, which was more supply chain driven congestion, where everything basically got stuck in a congestion, and where any ship, however old it was, however inefficient it was at sea, that didn't matter much because they were all waiting in line to get into ports anyway. So then it doesn't, a more efficient ship doesn't matter if you have a more efficient ship than a less efficient ship. Now I think we see more focus on both vessel efficiency, fuel consumption, and we see more focus on what can we say, skewing towards new energy, whether it's LNG or methanol. We also see conversion projects for existing vessels. What we have been focused on in our portfolio is that we have focused our investments on vessels designed and built after the financial crisis, i.e. they are now sort of up to around 10 years old. All these vessels have the new wide beam designs, which is what you would order today if you built a new one. They all have electronic engines. They're all upgradable and are more efficient than the prior generation, which were typically narrower, had much bigger engines, and therefore is less economic per produced container. So just as an example of what we're doing, I mean, we have 6 14,000 TEU container ships. We had them on 10-year charter to Evergreen. Now they're going, 2 of them have been converted already. They are now going 5 years to Hapag-Lloyd. We're putting more than $10 million in each of those vessels. It's been compensated by the customer. So we are increasing the dead weight. We are increasing the intake by 10% in terms of nominal containers. We're changing the bow, we're changing the propeller. We are doing all the stuff underwater to make it as efficient as possible. And per box, we are talking about a 20% reduction in fuel consumption. This is something you can really only do with that scale on a modern vessel like that, and which would be more difficult to do on older vessels. And then there has been recently, I would say up until a couple of months ago, there was quite some negative focus among analysts and I would think probably some investors too, about expected oversupply, particularly in the 13 to 16,000 TEU range, but also on the very large container ships, sort of 20 to 24. Now, many of these vessels have started to deliver. And what we see now, and also in our interaction with the liner companies, is that I think they all see that, this is coming out much more gradual than they expected. There are very few vessels like this ordered on speculation. The liner companies need to renew their fleets. And now we sense that the liner companies are out and really start looking for, increasing the asset portfolio, the vessel portfolio again. I think it's a combination of, one, you have more underlying cargo growth. The vessels are going a little longer, but that is probably more short term, whether a container ship now can go through the Red Sea, or if you have to take it through Africa, of course, you add another few days, i.e. absorb more capacity. But I think over and beyond that, newer vessels are more efficient, they are more flexible, and it's all down to, cost per produced box, which is a combination of renting the ship and the fuel is getting quite expensive now with the EU, the new EU rules where you need to pay, effective tax on CO2 emissions. Again, it really plays in favor of the newer modern vessels.
Do you think we will see some container shipping companies selling off some of their fleets at this point? And could this be interesting for SFL as well?
One thing is selling off the fleet. I think most of the liner companies are really more focused on acquiring assets and building market share more so than shedding assets. We are always on the lookout for good deals and modern vessels at the right price. Most of the transactions that we have seen has been more older vessels, tail end type assets, where we have not been so interested because we have tried to stay, focused and disciplined in terms of the assets that we have added to our portfolio. We have just recently expanded. We started with 4 vessels to Maersk at one stage. Now we have 17 vessels on charter to them. We just extended charters for 5 vessels quite recently, or 6 vessels in fact. 3 of the vessels for almost 6 years, and then 3 vessels for a shorter period. We are looking at optimizing and modifying and improving, efficiency of these assets. And I think, at least based on our interaction with the liner company, they really like, what they really appreciate is that when we come to them with proposals for existing or new assets, we come with a connection to the Fredriksen system. Mr. Fredriksen and the family is really the family, through trusts. They own 20% of SFL, and then the rest is really US listed, predominantly US investors. But we are working very closely together with our sister companies when it comes to, interacting with shipyards and suppliers. So we come with a purchasing power, we come with a lot of technical know-how from multiple segments, so that we can, that we can use to optimize performance for customers. So, that is, I think, one of the key reasons why it's grown from 4 vessels initially to now 17 vessels.
Let's have a look at the car carriers, and we've seen quite some signs of consolidation recently. And could you just recap quickly for us what's going on and explain the significance of all this to us?
Well, yeah, there isn't really so much consolidation as it is more acquisitions of assets. It's public that MSC has made a tender offer, and with a high grade of pre-acceptance for Gram Car Carriers. Gram Car Carriers is a tonnage provider into car manufacturers and logistics operators. So that doesn't mean that MSC through that gain access to the end user, but at least they gain access to a fleet of assets. Typically a lot of mid-size vessels. None of the vessels in that portfolio have dual fuel propulsion. 4 of our 7 car carriers have LNG dual fuel. But at least it's certainly a platform that can potentially be developed. MSC, as you know, is the world's largest container operator, where they have, they were very deep into the logistics chain with their customers. They have 2 car carriers only in their portfolio. They probably have 700-800 vessels in total. So far, car carriers have been a very small proportion of their portfolio. So it will be interesting to see how they build that. But if you look at the one key driver on the car carrier side is really, or maybe 2 key drivers there, has been, 1, Chinese exports. I think if you look at the last months, if you look at pre-COVID, we're up 7 times. So a lot of the incremental increase in transported vehicles has been driven out of China, and typically exports to Europe, exports to the US. So that's been quite interesting to follow. And then in combination with that, we had many years where the car carrier market was a little underinvested. There was a boom up in connection with the financial crisis, in the boom between 2000 and particularly 5 and 8, where they were ordered a lot of vessels. Then the market was really digesting that. Was a really tough market for many players. And then now, when a lot of older vessels have been phased out, and you see that influx of demand, particularly from China, you see a tightening market that has been quite dramatic over the last 2 years. You also have a dynamics where many of the customers, here car manufacturers, they see a demand from their customers again, who are purchasing cars and vehicles, that they need to use some cleaner fuel. So that is why virtually all the new buildings in that segment has been LNG dual fuel propulsion, and very few orders have been, call it classic conventional fuels. So it will be very interesting to see as these vessels deliver, whether they will be run on LNG or whether they will be run on conventional fuel, but that remains to be seen. Our 4 vessels in that segment, they all run on LNG because that's what the customers really want them to.
Could you take us through the recent EV and renewable tariffs imposed by the US on China? And is there a risk here that this could hurt the car carriers?
Well, whether it hurts the car carriers so much, of course, just a small proportion of the vehicles production, go on ships. But what it might do is to reduce expectations, or at least add some risk flavor to some of the companies that are focusing more on logistics out of China. But if you look at the new building order book, a lot of the orders that has been tied to Chinese export has been placed by Chinese operators. So it's not been a big proportion of the international players, as far as we see it, who has been tied to call it the incremental demand that is expected to come from China. So far it looks like stock prices are holding up. So far, I think everybody is waiting and seeing to see how this all plays out. If you look at the charter rates in the segment, it's still firm. You could say it's dipped a little bit, but we are still at a super profit level compared to invested capital and the time of charter rates you can get. So, from a long-term perspective, it's still phenomenally strong, even though it's a little softer than we've seen than we saw at the peak.
Great. Oil tankers. We've seen that your main owner, John Fredriksen, and other profile investors as well seem to have a very strong belief in the tanker space and predicting great times ahead, even after quite a rally. Could you go a bit into the reasons for this optimism?
Well, it's really basic logistics. I mean, oil, as many other commodities, it's a raw material. It needs to be moved, and you need to have something to move it on. The interesting thing with a tanker compared to a container ship or a ro-ro or a car carrier is that the cargo itself is quite corrosive. So, an oil tanker has more of a finite life, where you can easily upgrade and keep a container ship and a car carrier running until they're 30 years old, and even beyond that, if you really put some effort into it. An older tanker starts rusting. There will be very significant steel replacement requirements to keep this integral structure in place, and therefore they will be inherently more expensive to maintain. And also for an oil company who's hiring them, there is a higher risk, of course, of an incident with an older vessel if something happens. So and also if you look at the cost of the cargo itself versus some of the other commodities you see on the dry bulk side, the oil itself is much more valuable, and therefore the transportation cost is a smaller percentage of the overall cost of a cargo delivered from A to B. So in that context, even though new building prices have come up by arguably 30 to 40% from the bottom, and now the shipyards are starting to make some money again. It's still some way until they have super profits, but they're making money again. It's still at a relatively modest stage. If you look back 20 years or 15 to 20 years, and you look at the prices at that time, and also the construction cost at the time, when you look at steel plates, labor, and the cost of parts that goes into a ship, and you look at a more normalized inflation of all these factors, it's still very cheap at these prices. So as long as you believe that there will be an underlying market, you have some segments like the VLCC segment, which is just, the order book hasn't been lower since the 80s. And that oil companies who need to move oil, if we believe that oil will be a commodity that there will be a demand for, what will they be willing to pay, if there is a shortage of transportation capacity. So also if we look at the tanker side, most of the orders for the larger vessels have been with conventional propulsion. There have been some orders for dual fuel LNG in some asset classes, but it looks like many are stepping out again and ordering ships. Also, if you look at the shipbuilding capacity itself, and this goes for all segments, we're down probably 40%, maybe 50%, depending on how you count, since the late 2000s, since the late boom. And we've seen shipyards like in Japan, who announced now a few months ago that they had to shut down simply because they couldn't get the manpower to do the work. You have a significantly aging population in countries like Korea, who used to be a huge shipbuilding nation. Now, with an aging population, they also have issues with finding workers, and therefore they need to import more, have more, call it the workers who come in from other countries. You have an issue in China now with the population growth, which is coming down sharply. And China used to be the next country, as Korea was after Japan, China came after Korea. But right now there's nowhere to see. I mean, India, which many thought could come, I think so far hasn't. There is some shipbuilding, but it's not much. And I don't think, if you talk to market analysts, I don't think they expect them to become a big supplier of shipbuilding capacity. So you have a combination there of a smaller fleet, aging fleet in some of the segments, extreme low order book, combination with smaller, with a reducing your shipbuilding capacity. It's you could call it a recipe for a market squeeze. And as I said, what will an oil company pay to move oil? If you really need to move it from A to B, you're willing to pay quite a bit to get the oil to the right place in the end, I think.
What opportunities will SFL have to profit more from the strong tanker space?
Well, we have just recently acquired or agreed to acquire 3 LR2 product tankers that will go to one of the world-leading, energy commodity companies. We have a fleet of 13 tankers to various commodity players, already. And that is more on the crude and product side. And then we also recently announced an agreement to acquire 2 chemical tankers, which is, there is some overlap, you can say, on the product side, but the chemical market is much more sophisticated from a cargo perspective. These are stainless steel vessels, and they are dual fuel. So that's also an exciting, segment for us to look at. We used to have 2 smaller chemical vessels up until a year or so ago, but they are, very different type of assets, and more, I would say, standard type. They were coated vessels. So while these stainless steel vessels that we now are acquiring, they will go one on a long-term charter to Stolt-Nielsen, one in a pool with Stolt-Nielsen. Stolt-Nielsen have a very significant backlog where they have a lot of COAs, contract over affreightments, where they have volume contracts with some of their industrial customers. So I would say, compared to the tanker segment, the chemical segment is much more industrial in structurally, and therefore fits well for us.
Great. You already anticipated quite a few of my questions on the chemical tankers, and we've also seen several upward adjustments from analysts lately on the chemical tanker side, and we see that market fundamentals resemble those we see in the oil tanker space, at least to some extent. And we also see that the swing tonnage is looks like it's more been moving out of the chemical space and into the product space. And do you think that the future of chemical tankers look more exciting than for the product tankers?
Well, I think both are quite exciting. Of course, a chemical vessel is more expensive, for the deadweight capacity because it, as I said, built with stainless steel, is a totally different ball game from a cost of construction perspective. So you would prefer to run it on more high grade chemicals than use them as a swing tonnage in the more regular product tanker trade where you can use more standardized vessels. At the same time, you have more refined production, you have more refined products going, from many, energy hubs in the world. And the dilemma, that many market analysts have is that product tankers are inherently difficult to analyze. A crude oil, you could say you know where it's being produced and you can have a view on where it's being used, and then you can sort of predict how much oil is going to be moved on those crude oil tankers. That's and even there, analysts typically get it wrong. So when you look at the product tanker market, which is more of an arbitrage type market where one quarter the cargo flow goes from A to B, and then next quarter maybe it goes from B to A. Again, it's very difficult to make long-term predictions. But increased trade, increased sophistication is interesting. So I think both the product tanker market it looks interesting, and if that also takes away some of that, what we say, if that also adds some incremental cargo for the chemical tankers at high rates, that really benefits chemical tankers.
Do you think chemical tankers could outperform the product tankers in the coming years?
We don't make market predictions, but it's definitely interesting. It's definitely a segment with very low order book as well, very sophisticated assets. We see many of the shipyards who used to build chemical tankers have very long order books. I mean, we're talking 28. Some are already discussing 29 deliveries on certain assets. So I think that we are pretty confident that the next 2-3 years will look very interesting, always, I would say, almost across the board. But in the end, what we've seen time and time again is that usually ship owners are doing it to themselves. Ship owners get too excited, they start ordering vessels on speculation, and then suddenly you have oversupply with too many vessels in a sub-segment, and then you have effects on the side. This time could be a little different, certainly from a timing perspective, and that's partly driven by the uncertainty relating to propulsion, where many have been holding back on placing speculative orders. People who would otherwise maybe go in and order very early have been holding back. Now prices have come up, where I'm sure some are a little hesitant to order new assets. But I think underlying fundamentally, if you believe in raw material being dislocated from where it's being used, and if you believe in the cheapest and most energy-friendly transportation, which is shipping by far, it's going to be an interesting market for most of the players. So I think, while markets have come up on the tanker side, of course, you see many stocks that, has come up significantly. There are many signals which could indicate that we're still early in the cycle.
And you already commented on the 8-year charter that you secured for your chemical tankers with Stolt-Nielsen, and these chemical tankers are new builds, right?
Well, they're not new builds; they are underwater. So they're 1 to 1.5 years old. So they are very modern, but vessels underwater. So we expect to take delivery of both vessels in July, and they will then start producing cash flow, immediately.
Do you think you're getting a better deal here in terms of day rates and profitability than you would have got if you picked up dry bulk vessel or oil tanker at a similar age profile?
Well, that remains to be seen. But what we really like about these assets is that they are logistics type assets where you are using end users with some sophistication. So we are more than just a tramp owner. We go in as part of their logistics chain, which is really where we think we have an added value. And that's also how we think we can not only participate and enhance, hopefully, part of at least the C piece of that logistics chain, but it also in segments where we can get longer term employment, where we again can source perhaps a better structured financing package around it. So you have the combination of strong, good assets, strong counterparties, charter, cash flow visibility, and good financing around it. So that's why we like that segment. But we like many segments. We are segment agnostics. But we have seen, I would say, in the dry bulk side, it's difficult to find longer term charters. So it's more demanding to find new deals in that segment. While on the liner side, whether it's car carriers or container ships, I would call these chemical carriers also more logistics type assets really than a tramp tanker. That's spot on where we like to focus.
Excellent. Before we finish this talk, let's have a look at your shareholder policy. And the two last quarters, if I'm not mistaken, we have seen slight upward adjustments in your dividends. Is this a trend that is set to continue?
Well, when we do business and our long-term objective is to create long-term sustainable dividends and hopefully increasing. So when we pay dividends, I mean, while we never communicate a specific dividend policy, we don't say that next quarter we're going to pay this and the quarter after we're going to pay that. The board, as part of that decision around dividends, every single quarter is to not only look at the quarterly performance this quarter, but also look at the long-term cash flow characteristics. So that's why we keep investing, and that's how we recycle effectively capital. If you sell older vessels, we invest in newer vessels where we think we can generate more dividend capacity long-term, even though an old asset may earn a lot of cash flow, in the very near term. It's also a finite period where you can expect to make that. So our objective is to increase the dividends, but we cannot guide on when it's going to be increased or how much, or that's why we're there.
Ole Hjertaker, it was an excellent conversation, and thank you so much for coming back to Marhelm to talk with us.
Yeah, thank you, and thanks for inviting me.